This is Financially Fit Business with Ruth King.
Welcome to the Financially Fit Business Podcast. Here you discover ideas, tactics, news, and information that matters to the health of your business or your clients' businesses. I'm your host, Ruth King. Here is how we will help you increase the financial fitness of your business today. Subtle changes in P&L and balance sheet trends mean a lot. It's best to pay attention to these small changes and resolve them before they become major cash flow, productivity, or profitability problems. In the last episode, I covered little changes in the profit and loss trends. In this episode, I'll discuss gross margin changes. Let's get started. Gross margin, as we all know, is simply gross profit divided by revenue. And in companies that have seasonal businesses, the monthly trends can go up and down and up and down and up and down. Likewise, if they have many, many different products, and each product has a different gross margin, and certain months, the one product with a high gross margin is produced a lot and sold a lot, and the next month, a product with a lower gross margin is produced and sold a lot. You're going to see a lot of changes in the monthly gross margin ratios. It will go up and down and up and down, up and down, depending upon whether it's a high gross margin product month or a low gross margin product month. And the reason that I say it from a seasonality perspective is busier and slow months is because a lot of business owners have a tendency to discount when it's slower. And as a result of that discount, the gross margins are going to be lower. If they are going to discount, then they should discount off the bottom line, i.e. decrease their net profit per unit of revenue, and then work backwards to find out how much they can actually discount without losing money for every product that they sell. So if a business owner or one of your clients doesn't do that, in busier times and slower times, the gross margins should be the same. Now, gross margins can also change if there are months with 5-week payrolls. Because in the months where there's a 5-week payroll, a lot of times, unless you accrue that last few days of payroll, you're going to see decreases in gross margin because you have increases in expenses. So that's why I look at the monthly numbers with a grain of salt, because what happens a lot of times is you have one of those things going on, and the margins are up and down, up and down, up and down, up and down, and generally they're up and down within a specific range. But they're still up and down and up and down. When we look at the trailing numbers, we've taken a year's worth of data a month at a time. And as a result of that, we're in a situation where all of the seasonality should be out. All of the higher and lower gross margin products should be out. And we should look at a continuum based on a year's worth of data and look at the trends based on a year's worth of data. Now, before you say, hold on, we might have months that we have high product margins and months that are low product margins. Yes, that's true. But if you're going in a situation where those months, low gross margin product months are always in January and February, for example, and then you have the year's worth of data to even out the seasonality of January and February. What you might want to do is look at those low product months and, low product margin months for those products and see whether you still have to do that, produce them. Probably the answer is going to be yes, because it covers a little bit of the overhead. However, can we get higher gross margin products to offset that more often? And if you see that and you start seeing higher and higher gross margin products being sold, then you're going to see an increase in the long term, the trailing gross margin graphs going in a positive and a upward direction. So monthly is important, but trailing is even more important. So when I look at monthly, I look at it from a perspective, okay, where are we? And I look at it in a history and a continuum to see whether the gross margin, even though it's going up and down and up and down and up and down, whether the gross margin is going up and down within a specific range. So for example, if it's always between 40% and 50% as a general rule, what would happen if it dropped down to 25% one month? Like, what happened? That should be a huge warning sign or even if it dropped down to 30 or 35%, um, what happened? What went on? And you really should investigate that. And it's fresh in everybody's mind because it's only a month. Or likewise, the other thing is if it jumped to 60% and it's normally between 40 and 50, what did you do that made it differently, and made it that much better? The thing that I would be careful about in those situations is having a little bit of what I call financial statement fruit salad. And that means that we have revenue in a month, but not the expenses against it. So that will give us the high 60, or we have expenses for the month and we didn't book the revenues for it. So we have high expense, lower revenue, which would make us go down to the 30 or the 40. So monthly is important as long as it stays within a specific range. Trailing, to me, once you see what's going on with monthly, not headed in the right direction. We'll be right back. Thanks for listening to the Financially Fit Business Podcast.
Financial advisory services are the key to the longevity of the accounting profession. If you want to get started providing advisory services or want a review of a finance course you took in college, Ruth King's manual, Understanding Financial Trends Analysis, might be your first step. This manual gives you the information you need to help your clients with their financial statements. A great start or addition to your financial advisory practice. You help them with clarity on their business's financial health, the ability to spot impending issues and resolve them before they become a major crisis. Less stress and sleepless nights worrying about the financial part of their business. Your Financial Statement Trends Analysis Manual is the reference guide. What do you want in your financial advisory services practice? Click on the link below for more information and to order.
We're back. Thanks for listening to the Financially Fit Business Podcast. Before the break, I talked about the monthly changes in gross margin and making sure that we keep them within a specific range. And if they're above that range for a month or 2 months or whatever, to find out why they're not in the specific range that they've been in for a period of time. And if it's financial statement fruit salad, i.e. we forgot to book revenue or something along those lines, then we know what the story is and we can explain it. So now I'm going to talk about the trailing numbers and trailing gross margin numbers. And obviously we want those trailing numbers and that trailing graph to be either equals significantly, the same number, or actually increasing. Even if it's increasing a little bit, remember that trailing increasing a little bit or decreasing a little bit tells a larger story because we're taking a year's worth of data a month at a time. So little increases in trailing gross margin are good. Little decreases in trailing gross margin, we have to start investigating. And this is what I normally see is when I see the trailing numbers decreasing just a little bit. And you can see this also in the spread, as we talked about during the last episode, between the revenue line and the gross profit line. That it's becoming less and less parallel, and it's getting wider and wider. So I look at that. If it's a decreased gross margin, I want to know why. And obviously, your clients and you as a business owner should want to know why too. There are generally 2 or 3 reasons that this happened. Number one, and this is the one that drives everybody crazy, is suppliers sneak in price increases. I can't tell you how many times I've seen this. And they just, raise prices, and your prices to your customers are based on what the former prices were. And all of a sudden your gross margin goes down a little bit. It doesn't, have this huge drop. It's just a little drop. And so that's the first warning sign. And I'll never forget, I saw it with one of my clients, and he went back and looked at some of his supplier invoices and got pissed off. Excuse me for saying it that way, but he actually did, because the supplier had snuck in a price increase. I think it was about 5%. And so this is not going to show up as some huge number up or down. It's a little changes in a subtle way of that gross margin going down. And so he calls the supplier on the phone. He's telling me the story and said, "I'm not paying the price increase because you didn't tell me." And I said to him, "How well did that work out?" And he goes, "Not very well." But the thing was that had they told him and the prices would have gone up just a little bit so that they could keep their margins and their net profit the way they wanted it to be. And so for a month or so, because we look at numbers every single month, he had lower gross margins simply because there were increases in prices and he wasn't aware of those increase in prices. So please, please, please make sure that you look at all of the supplier invoices and make sure that they haven't increased prices without telling you. Now, there are times when they increase prices and they do tell you, and then owners have to make a decision as to whether they're going to increase their prices. You almost have to, because why should a company make less profit because their prices went up because supplier prices went up? So this is usually a good reason to actually increase the prices, um, because of supplier increases. It is what it is at that particular point. The second thing is where you have given the company owners or managers have given raises, and the raises are not reflected in the increased prices to the customer. And obviously they're in the increased cost if they're direct wage raises. And if they are overhead type raises, it will affect the profitability. The overhead will go up and the profitability will go down, right? So let's take the cost of goods sold first. This one's the easy one, actually. So if we are gave everybody a 5% increase, on average, the minimum increase in pricing should be 6.5%, because FICA, Medicare, workers' comp, unemployment, all the fun things that we get to pay as benefits on top of the actual increase in prices. And we look at probably about 30% in most areas of the country. In some areas of the country, it's actually more. But in other areas of the country, it's around 30%. So I use that as a good baseline number. And that's where your labor cost should have increased to 6.5%, and then add the material costs on top of it and all that sort of other cost of goods sold to get at what the new prices should be to the consumer. The other thing that's really important is that overhead. Now, overhead's a little bit trickier because overhead increases actually have to do with where you are with respect to your overhead costs per unit of revenue. So, for example, if you are billing hours per spec and you add an overhead person and that person's increase is, $5,000 or whatever it is, and there are 50,000 billable hours, that's an increase of, 5,000 divided by 50,000, which is, about, not much. Okay. So it's about 10, 10 cents. So it's not going to affect your overhead that much. However, that's the way that you do it. If it's $5,000 and it is 5,000 hours, then you have to increase overhead costs by $1 an hour. So you have to play with it from an overhead perspective to see how much you have to rate prices so that the overhead can actually stay exactly the same as it was. Okay, so again, if we look at the monthly, we're looking to make sure that the gross margin stays within a specific range. And if it doesn't, then we probably have a little bit of fruit salad or something happen, and we have to figure that out. And then from a trailing perspective, we have the issue with respect to suppliers increasing prices, increasing prices because of raises. And the third one is actually productivity issues. So, if somebody had retired, for example, who is really, really good at, producing whatever the products are, and you're in a situation where you have newer people producing them and they're not as quick, they're not as efficient, and it's taking longer to produce those particular products, then yes, your gross margins are going to go down a little bit. So that would be the third reason as to why your your gross margin on a trailing basis was going down. And yeah, you're going to see this all on the monthly basis too, but I look at the trailing basis to see a lot of these issues to make sure that we take care of them. You have to get the people experience. So that might be something you just bite the bullet at. for a little bit of time until they get the experience they need to do the products. So, all right, look at suppliers, look at raises, and look at productivity issues for small changes in gross margin. Thank you for joining us. Choose one thing that you discovered and implement it in your business. These ideas, tactics, and strategies help you make more money, have more free time, and give back. If you like today's program, spread the word. Please review this podcast on any device you're listening to it on. Help a business owner improve the health of his company. For comments or questions, call me at 770-729-8000 or email rking@financiallyfit.business. Thanks for listening. Have a great and profitable day.